$4 billion worth of tokens, one fundamental classification question, and a firm that got the answer wrong in a way that exposed it to the full force of EU securities law. This is the story of the MiCA scope question, the classification fight that determines whether your token falls under MiCA's relatively streamlined white paper regime or under MiFID II's full securities law with authorization requirements that could take years to meet. Here's what most people get wrong about the MiCA scope question. It is not about what you call your token. It is about what your token actually does. And regulators are very good at looking past the label. If you are launching a token, advising a firm on token classification, or running compliance for a platform that lists tokens, this episode is the one where you need to get comfortable with the line between MiCA and MiFID II. Because getting it wrong on either side has career-defining consequences. MiCA is explicitly designed as a residual framework. It applies to crypto assets that are not already covered by existing EU financial services law. This is stated in Article 2 of the regulation. The first question for any token is not does MiCA apply, it is does MiFID II apply first. If the token qualifies as a MiFID financial instrument, a transferable security, a unit in a collective investment undertaking, a derivative, MiCA does not apply. That token is a security, full stop. The MiFID financial instrument test is essentially three questions. First, is the token transferable and negotiable on financial markets? Second, does it confer economic rights, profits, dividends, governance votes in a firm that make it look like equity or debt? Third, does the market treat it as an investment, buying it for capital appreciation rather than to use the underlying service? If you answer yes to these, you are in MiFID territory, regardless of what the white paper says. If you have done token classification work, I want to hear your experience. What was the hardest part of drawing the MiFID line for a specific token? Was it governance rights, economic returns, or something else entirely? Drop your answer in the comment. Title 2 of MiCA covers what are often called utility tokens, the catch-all category for crypto assets that are not ARCs, not EMTs, and not financial instruments. A genuine utility token gives the holder access to a product or service. Think of an API credit that you buy and spend on a platform. You are not investing, you are pre-purchasing a service. The token has functional value tied to actual usage, not speculative capital return. If a token qualifies as a MiCA crypto asset, the offerer must produce a crypto asset white paper. This is MiCA's equivalent of a prospectus but lighter. The white paper must contain information about the issuer and project, a description of the token and the rights it confers, the underlying technology and risks, and the mechanisms for primary issuance and trading. It must be notified to the NCA and published before any public offer. Let me walk you through a hypothetical that is drawn from real patterns regulators have documented. A fintech startup launches what it calls a utility governance token for its DeFi lending platform. The white paper says holders get access to platform features and the ability to vote on protocol parameters. Sounds utility-like? But here's what the token actually does. It pays quarterly revenue distributions from the platform's fee income. Holders bought it expecting capital appreciation. The secondary market trades it on the same metrics as equity. From a regulatory standpoint, that token fails the utility test on multiple grounds. Revenue distributions to holders look like dividends, an economic right tied to the firm's performance. Market pricing driven by platform profit expectations rather than service demand looks like equity valuation. Governance rights over the protocol could, in some readings, constitute a collective investment undertaking feature. The NCA, applying ESMA's guidance on token classification, has strong grounds to say this is a MiFID security, not a MiCA utility token. The consequences of misclassifying a security as a MiCA utility token are severe. First, the public offer becomes an unlicensed securities offering, triggering Prospectus Regulation violations. Second, operating the platform without MiFID authorization is itself a criminal offense in most member states. Third, any CASP that listed the token may also face liability for facilitating trading in unlicensed securities. Fourth, investor compensation claims can follow if token holders suffered losses. But there is a second, less discussed failure mode, overclassification. A startup assumes its token might be treated as a security and structures its entire compliance program around MiFID authorization, which can take 12 to 18 months and cost millions. If the token genuinely qualifies as a MiCA crypto asset, this is all unnecessary. The overclassified firm delays its launch, burns runway, and loses competitive ground, not because the law required it, but because legal counsel was too cautious. ESMA has produced guidance specifically on the classification of crypto assets as financial instruments under MiFID. The core test is economic substance over form. ESMA asks supervisors and firms to look at the economic rights attached to the token, the circumstances of the offer, the underlying mechanism, and market expectations. No single factor is decisive. Classification is a holistic assessment, which is exactly why it is hard and why legal opinions can differ. Some firms operate in both regimes simultaneously. A crypto platform might be a MiCA-authorized CASP for spot trading of utility tokens, while also being a MiFID-authorized investment firm for security token trading. This dual-licensed model is the most complex compliance build, but it is increasingly the reality for firms with broad product ranges under MiCA Article 60. MiFID investment firms can actually provide most CASP services without a separate MiCA authorization, which creates an important asymmetry. NFTs are largely out of MiCA scope, but only if they are genuinely non-fungible and unique. ESMA has flagged that NFTs issued in large series with identical characteristics may start to look economically fungible, and therefore may fall back into MiCA scope or even MiFID scope, depending on their economic function. Fractionalized NFTs are another flashpoint. Slice an NFT into tradable pieces, and the pieces start looking like transferable securities. This area is still developing, and practitioners need to watch ESMA outputs closely. When a CASP admits a token to trading on its platform, it inherits obligations too. Under MiCA's admission to trading rules in Title V, a CASP must verify that a white paper exists and has been notified, conduct its own due diligence on the issuer and the token, satisfy itself on market integrity concerns, and maintain admission to trading policies. If the CASP lists a token that turns out to be a misclassified security, the CASP faces its own regulatory exposure, not just the issuer. Here is a question for the practitioners in the audience. Have you encountered a real token that sat genuinely in the gray zone between MiCA utility token and MiFID financial instrument? What were the deciding factors in the classification call? Share your experience in the comments. This is one area where real practitioner knowledge is far more useful than any guidance document. Scope classification has a direct AML dimension that is underappreciated. A CASP's admission to trading policies must include consideration of the MLTF risk profile of any token it lists. The EBA risk factor guidelines, now extended to CASPs, specifically identify high-risk product features including anonymity-enhancing characteristics, complex multi-layer token structures, and tokens with opaque governance. A CASP that lists a token with these features without a documented risk assessment is failing both its MiCA admission obligations and its AMLR duties simultaneously. Here is the practical classification workflow a firm should follow. Step 1. Gather all documentation, white paper, tokenomics, governance rules, economic rights structure. Step 2. Apply the MiFID financial instrument test, transferability, economic rights, market expectation. Step 3. If MiFID applies, escalate to Securities Law Counsel immediately. If not, Step 4. Confirm the token is not an ART or EMT. Check whether it references multiple assets or a single fiat currency. Step 5. If it is a plain MiCA crypto asset, ensure a compliant white paper is produced and notified. Document every step of this reasoning. I have built out a full token classification decision tree with all the MiFID versus MiCA versus RT versus EMT tests mapped out clearly at DaVinciDiligence.com. If you're doing classification work right now, this will save you considerable time. The full audio investigation for this episode is also available on our Spotify podcast, DaVinci Diligence. Good practice in token classification means two things. First, an independent legal opinion, not just internal analysis, that documents the MiFID test, the ART and EMT exclusion analysis, and the conclusion with full reasoning. Second, a process for ongoing monitoring, because tokens can change. A token launched as a utility today could, through secondary market trading behavior and economic evolution, develop characteristics that shift its classification over time. A static opinion is not enough. NCAs have the power to order CASPs to delist tokens that should not have been listed, to suspend trading, and to require corrective action. Where misclassification is found, supervisory authorities can also publish statements that effectively destroy market confidence in the token. And under MiCA's sanction regime, which we cover in Episode 8, individual senior managers of firms that facilitate trading in misclassified securities can face personal fines and professional bans. The core lesson of this episode is this. Token classification under MiCA is not a box-ticking exercise. It is a substantive legal analysis with major commercial licensing and AML consequences on every side of the answer. The EU has built a framework where the wrong classification in either direction can be existential for a business. Get it documented, get it reviewed, and build in a process to revisit it as the token evolves. Subscribe to follow the full MiCA series. Next episode, we go inside the CASP authorization process. What the NCA actually examines, what happens to a firm with legacy weak KYC that applies for a MiCA license, and how conditional approvals and refusals are being used. That is episode 3. See you there.